The headlines say the market is cooling. But in some cities, it's not just cooling, it's cracking. Sky-high mortgage rates, surging insurance premiums, overbuilt neighborhoods, and buyers who've vanished. In this video, we're exposing 7 U.S. cities where the housing market is flashing red, places where values are dropping, listings are piling up, and the so-called boom is starting to feel more like a bust. Is your city on the list? Let's find out. Austin, the city that once couldn't build homes fast enough. From 2020 to 2022, it was the place. Tech jobs, live music, no state income tax, and Californians arriving by the thousands. Home prices? They exploded. The median listing price in the city jumped from $369,745 in April 2020 to $625,000 in April 2022, an uptick of 69% in just 2 years. At the same time, inventory plummeted, though it quickly recovered to pre-pandemic levels by 2023. But in 2025, that rocket ride is reversing. Prices have already dropped nearly 9%, bringing the median home back down to about $536,565. Still high compared to Austin's median household income of $91,501. Why the sudden shift? First, mortgage rates. At 7%, the average monthly mortgage is about $3,500, and that's before taxes and insurance. Second, tech layoffs. Meta, Google, Oracle, each trimmed their Austin workforces. The hiring frenzy is over, and so is the home buying spree that came with it. Third, listings are flooding the market. Inventory is up 39% compared to last year, and nearly 42% of homes for sale have already had price cuts. Fourth, overbuilding. Developers in Leander, Georgetown, and Pflugerville went all in during the boom. Now they're slashing prices, offering cash back and incentives just to move units. And then there's this: property taxes. Some homeowners have seen a 25% increase in just 2 years. Rents are falling, down 4.1% year over year, and short-term rental restrictions are forcing Airbnb hosts to exit. Even migration is cooling. The wave of Californians? It's slowing. And some of them, they're rethinking the move. Austin still has the music, the energy, the talent. But in 2025, its housing market is singing a different tune, and the party might just be over. St. Louis, a city that's flown under the radar for years, known for its historic charm, baseball pride, and modest home prices. But in 2025, the cracks are showing, and fast. Let's talk numbers. The median home price in St. Louis hovers around $235,000. Sounds cheap, right? But the city's median household income is just $62,000. And with mortgage rates still above 7%, that affordable home is getting harder to afford. Here's where it gets concerning. Realtor.com predicts a nearly 12% drop in home prices this year alone. That's not a dip. That's a market correction. Why the slide? First, listings are stacking up, buyers are pulling back, inventory is rising, and sellers, they're slashing prices to stay competitive. Second, mortgage affordability. Even with lower home values, high interest rates are squeezing buyers out of the market. Many can't get approved. Others simply can't stomach a $2,000+ monthly payment on a $220,000 house. Third, insurance costs and taxes. Missouri isn't immune to the nationwide rise in insurance premiums and property tax reassessments, especially in older urban cores like St. Louis. And don't forget, economic uncertainty. Job growth in the region has stalled, and companies are cautious. Without strong employment prospects, housing demand takes a hit. If the national economy hiccups in 2025, St. Louis won't just feel it. It'll absorb the full shockwave. This isn't a crash yet. But for a city long praised for affordability, St. Louis is skating on thin financial ice. And if the downturn accelerates, it could be one of the hardest-hit midwestern metros in the country. Washington, D.C., where the suits are sharp, the power is real, and the home prices, they're eye-watering. But in 2025, even the capital can't escape a housing cooldown that's turning from a whisper into a warning. Right now, the median home price in the D.C. metro sits around $620,000. And with mortgage rates pushing 7%, that translates to monthly payments topping $4,500 before taxes and insurance. And here's the kicker: wages aren't keeping up. The average household income in D.C. is about $93,000. That's solid, but not solid enough to make a $600,000-plus home feel manageable. What's happening? First, home prices are sliding. Realtor.com projects a 10.2% drop across the metro area in 2024 to 2025. That's one of the steepest forecasts in the nation. Second, buyer demand is fading. Listings are sitting longer, some over 70 days, and the bidding wars of 2021 are a distant memory. Nearly 1 in 3 homes has dropped its asking price in the last 60 days. Third, the federal job market isn't immune to slowdowns. Budget uncertainty, hiring freezes, and hybrid work mean fewer government relocations and less pressure on the housing supply. Fourth, property taxes and homeowner costs are rising. Insurance premiums in the DMV area have crept up significantly, and maintenance on aging properties is no small bill. And here's the wild card: migration patterns. D.C. isn't pulling in new residents like it used to. Young professionals are heading to lower-cost cities with remote flexibility. That drain could dampen demand long-term. D.C. may run the country, but it's not running from this market shift. 2025 is shaping up to be a cold year for Capitol Hill real estate. Phoenix, a city that soared during the pandemic, attracting remote workers and investors alike. Between February 2020 and February 2025, home prices in Phoenix surged by 53%, outpacing the national average of 45% during the same period. But in 2025, the tide is turning. The average home value in Phoenix has declined by 2.6% over the past year, now standing at $422,080. Median sale prices have dropped from $465,000 to $445,000 in just 5 weeks, a 4.3% decline. What's driving this shift? First, an oversupply of homes. As of April 2025, there were nearly 20,000 active listings in the Phoenix metro area, the highest in several years. Second, high mortgage rates. With rates above 7%, monthly payments have become unaffordable for many, pushing potential buyers to the sidelines. Third, investor retreat. The luxury market is slowing, with $1 million-plus contracts dropping for 6 consecutive weeks. Multifamily permits have hit their lowest level since 2019. Fourth, rising inventory and decreasing demand are putting downward pressure on prices. Sellers are now receiving, on average, 97.7% of their final list price, compared to 97.9% a year ago. And here's the wild card: economic uncertainty. Volatile financial markets and a cooling job market are shaking consumer confidence, further dampening housing demand. Phoenix's housing market, once a symbol of rapid growth, is now facing a significant correction. As supply outpaces demand and affordability remains a challenge, the city may be heading toward a prolonged downturn. Denver, Colorado, is experiencing a notable drop in house prices due to a combination of factors reshaping its housing market. Firstly, demand has slowed significantly as employers have called workers back to offices, reducing the influx of remote buyers who previously drove up prices during the pandemic. This shift has led to structurally lower homebuyer and renter demand. Secondly, the city has seen a sharp increase in housing inventory. By the end of March 2025, there were 9,764 condos and single-family homes available for sale, a 67% rise from the previous year. This oversupply has given buyers more options and negotiation power, contributing to price cuts. High mortgage rates and affordability issues also play a critical role. Denver remains one of the least affordable housing markets, with median home prices still around $599,000. However, prices have fallen 5.6% year over year as of March 2025, following a 5.5% drop in 2024. New seller listings have surged by 33.3% compared to the previous year, further adding to the growing supply. Experts warn that if current trends persist, home values could drop by 8 to 10% over the next 12 months. However, falling mortgage rates might mitigate the pace of these declines. Despite the price drops, Denver's housing market remains competitive, with the average home value at $552,056 as of February 28, down 1.2% from the previous year. In summary, the combination of increased inventory, decreased demand, high mortgage rates, and affordability challenges has led to the current softening of Denver's housing market. While this presents opportunities for buyers, it also underscores the ongoing challenges in one of the nation's most expensive real estate markets. Jacksonville, Florida, once a thriving housing market, is facing a significant downturn. As of early 2024, home prices have dropped 6.5% year over year, while home sales have plunged 27%. The sharp decline is primarily driven by Florida's escalating property insurance crisis, increased housing inventory, reduced demand, and persistent affordability issues. Insurance premiums in Florida have skyrocketed 102% over the past 3 years, with Jacksonville homeowners now paying an average of $6,000 annually, 3 times the national average. Rising condo fees have further deterred buyers, especially in the condominium market, leading to an oversupply of unsold units and downward pressure on prices. By April 2025, Jacksonville had 5,615 homes for sale, with a median price of $304,661, slightly down from the previous year. Despite falling prices, homes remain unaffordable for many. A 2023 study found that Jacksonville properties were overvalued by nearly 40%, and high interest rates have pushed monthly payments beyond the reach of average households. The market has cooled visibly. In June 2024, the median home price reached $424,000, but signs point to a slowdown. Currently, 28% of listings have seen price cuts, placing Jacksonville among the top 10 U.S. cities for markdowns. Looking ahead, projections vary. Some experts foresee stabilization in 2025 as inventory grows and interest rates ease. However, others warn that persistent insurance and affordability challenges may continue to depress prices. For buyers, opportunities may emerge, but for sellers, competition is growing. Las Vegas, Nevada, a city known for high stakes and hot markets, is now seeing its housing market cool down. As of May 2025, median home prices hover between $455,000 and $485,000. But the trend is shifting. Prices are beginning to slide, and here's why. First, high mortgage rates are hitting hard. With 30-year fixed loans at 6.83% and 15-year rates at 6.03%, borrowing is more expensive than ever. That's cutting into affordability and pushing many buyers out of the market. Next, inventory is rising fast. In March 2025, over 5,400 single-family homes sat unsold, up 63% from the year before. More choices for buyers mean less pricing power for sellers. Buyer demand is fading too. In September 2024, home sales dropped more than 16% compared to the previous month, signaling growing uncertainty. Then there's the housing crisis. Affordable homes are scarce, and with land development limited, half of Clark County residents are priced out. All of this points to a market shift. Only 15.4% of homes sold above asking in early 2025. And with supply increasing, buyers now have the upper hand. Investor activity is still strong, 23% of all home sales, but the rise of build-to-rent properties is changing the landscape. So what's next? Experts predict small declines ahead, down 0.2% by April's end and 1.3% over the next year. But thanks to solid fundamentals like population growth and a diverse economy, a full-blown crash seems unlikely. For now, Las Vegas is becoming a buyer's market, and the game is changing.